Alright guys, thank you so much for joining me, and like I mentioned in my last video, I'm going to reveal my entire stock market portfolio to you guys. And I currently have 4 different accounts with M1, and I'm going to talk about the accounts first. So if you want to jump right over to the stocks that I have, I'm going to leave the timestamp right below. In my last video, I mentioned that I have close to $16,000 in my account. As you can see, my current M1 total is $17,321.53. That's an increase of about $1,410, but does that mean that I gained that much? Actually, no. I deposited an additional $800, so out of that, only about $610 is due to market appreciation and a little bit of dividends. Now, the reason why I mentioned the $800 personal deposit is because whenever I watch financial channels and they do their own review, I always wonder if that total amount is due purely from market appreciation, or if they're able to just dump in a lot of money, which basically inflates the total dollar amount. So for the sake of transparency, I just wanted to let you guys know that I did put in an additional $800 from the time of that last video until now. But still, $610 appreciation is something to scoff at. Now, like I mentioned, I have 4 different accounts with M1. This is the first one. And this account is purely for just the referral bonuses that I get whenever people sign up to M1 Finance using my referral links down below. So this is my first and only referral bonus I got on April 9th. So whoever used my link below to sign up, thank you so much. And as you can see, not only do I get $10, but you also get $10 if you use the link down below. You don't have to use it, of course, but it'll be helping out my channel. So with this referral bonus account, and I do have another one that's open for my daughter. She's currently 1 year old, and I have $100 in her account. For those two, I only have these 2 stocks. The first one is the Charles US Broad Market ETF, and the second one is the Vanguard Total Stock Market ETF. Because this account and my daughter's account have such small amount to begin with, and just choose to have these 2 ETFs. As you can see, have it split evenly 50%. So for example, if I put an additional $10, it's going to put $5 on the first one and another $5 for the second one. Alright, now we're going to move over to the larger amount. The first one being the Roth IRA number 1 account, and I also have my wife's, which is named Roth IRA number 2. As you can see, this is my biggest account at almost close to $13,000, and the stocks I'm going to show you is virtually identical between Roth IRA number 1 and Roth IRA number 2. It's just a dollar amount's a bit different. So let's get right down to it, and I'll talk about the various stocks that I have. So the reason why I personally choose to invest with M1 is because they give you the option to create pies. Basically, I have 6 different pies right here, and within each pie, you're able to put in different stocks, ETFs, or bonds. As long as each individual pie, the total percentage amount equals to 100, you're able to do that. So the very first one, I have bonds. The second one is consumers, more consumer discretionary. Third one is the technology sector. The fourth one is the industrial sector. The fifth one is real estate, and the last one is dividend. The ticker symbol at the very front, it basically shows you that I am basing these off of the Vanguard sector ETFs, but like you'll see when I go into each individual pie, the ticker doesn't always correspond with the stocks that's within the ETF. I just choose these for simplicity. So like I mentioned, M1 Finance, you're able to create pies, and these are the allocations that I have. Bonds, I have 5% in, and the rest is divvied up. It's 19%. But the total amount is going to equal 100. Same with my wife's Roth IRA, which is once again Roth IRA number 2. She has 5% in bonds, and the rest is split evenly, 90% each, in these different sectors. So let's start off with the smallest amount. On my bonds, I have almost $755, and these are the 5 different bond ETFs that I have invested into. I have the short term, which is about 1 to 3 years, and the intermediate, which is 3 to 10 years. The long term is anything more than 10 years, and the extended is for those 20 to 30 years. And at the very bottom, I do have the Vanguard Total Corporate Bond ETF. Now, if you look at it with the gains, as you can see, the Total Corporate Bond ETF is doing much better. This might have to do with the fact that the Federal Reserves, they're buying a lot of corporate bond ETFs, but 1.64% for bonds, you can't really complain because they don't really go up as much as investing in stocks. And I am currently only 29 years old, so you might be thinking, why am I even choosing to invest in bonds while if I have if I put that 5% in stocks, I may be getting a better return. But I'm using bonds a bit differently. I'm not really relying on the bond ETF for income. I'm choosing to put my uninvested cash into it. So along with the cash balance that I have, $551, I also have this bond pie basically. I'm holding it here because I don't want to have such a large amount just in my cash balance, not doing any appreciation or not receiving any dividends. So instead of just leaving the cash in here where it's basically collecting dust and losing value to inflation, I decided that I'm going to put 5% into the bonds pie. And if the stock market does go down, or if I see any buying opportunities, I'm going to sell from my bond pie to invest into the other stocks that I have. That's basically the 5 different bond ETFs that I am holding in my bond pie. Once again, it's only 5%. And let's get to the other pies, which have a more considerable amount of 19% of my total investable amount. Let's start off with consumer, and if we scroll down, I have 10 different stocks in this consumer pie, which is the same number of stocks I have in my other pies as well. As you can see, each stock is going to receive 10%, and 10% times 10, each pie has to equal to 100%. So because each of my stock pie has 10 stocks each across all of my investment accounts, at least in my Roth IRA and my wife's Roth IRA, I'm currently holding 56 different stocks and the bond ETFs. And you might be thinking, if I'm deciding to hold that much stocks, why I'm not just choosing to invest in a Vanguard total market ETF. And the reason why I'm choosing to create my own indexes in a way is because the total stock market ETF and also the S&P 500 ETF by Vanguard, they have a lot of weight towards the technology, at least in the very top holding. As you can see, this is off of the Vanguard website. This is the Vanguard's total stock market ETF, and this is the top 10 holding within this ETF. As you can see, the top 10 holding accounts for almost 23%, and it's heavily weighted towards the technology sector. As you can see, Microsoft, Apple, Amazon, Alphabet, Facebook, and even Visa. So 1, 2, 3, 4, 5, 6 of the top 10 holdings within the VTI is lean towards the technology sector. Same with the Vanguard S&P 500 ETF. We have Microsoft, Apple, Amazon, Google, Facebook, and also Visa, but this is much larger at 27%. So because although right now technology stocks are doing very well, they're appreciating much faster than other sectors. They also have the downside of if they do go down, they do drop much more substantially and faster. So this is why instead of choosing to invest in just purely ETFs, I decide to create my own indexes. And also another reason why I decide to split it evenly, 10% each. So even though I do invest and I contribute to capitalism, at least when it comes to stocks and the way I divide it, I'm pretty much a socialist. I like to do more equal because right now, as you can see, Amazon is my top gainer at 31%, but I don't want this entire pie being so heavily leaned towards Amazon. So by having each of these stocks at 10%, it balances out a bit better. So as you can see, I have Alibaba, which is the Chinese Amazon basically. They have a lot of different SKUs within Alibaba as well. If you watch Mission Impossible, at least the newer ones, they're financed by Alibaba Pictures. Most of the stocks that I decide to invest in, I like to choose ones that have different revenue streams, so they're not just limited to one specific things. The second stock I have is Amazon. With the whole quarantine thing going on, Amazon has gone on substantially, but a lot of people getting used to online shopping, this is why Amazon is a no-brainer. The third stock I have invested is Carnival, and even though with the whole pandemic, cruise lines, they've gotten beaten down a lot, my average cost basis is $14 per share. So because I've gotten it at such a low price, I'm more than happy to just stay invested and just wait it out until it reaches up to $20 or $30. Of course, there's a possibility of each of my individual stocks going bankrupt, but that's the risk you take when you invest. The next stock I have is Disney, but even though their parks and their movie production is shut down, they have Hulu and also Disney Plus. So this is why I like picking companies that have different SKUs. So Disney, even though they are not able to open their theme parks, at least their online streaming business, they're able to provide some steady stream of revenue. The next one I have is the Dunkin' brand. They also own the Baskin-Robbins brand. And the reason why I decided to go with Dunkin' instead of Starbucks was has to do with the prices. and also the offerings that they have. As you well know, they have different donuts, snacks, and things like that. So unlike Starbucks, while they do have food options, the pricing of Dunkin' Donuts coffee and also the snacks and donuts that they have is much more economical. And right now, with unemployment going up and up, a lot of people who might be drinking Starbucks to get their caffeine fix, they might decide to choose to Dunkin' because of that slight price difference. And there's a lot less Dunkin' stores compared to Starbucks, which means that there's more opportunity for expansion, at least for Dunkin' Donuts. And the next stock is Ferrari. Compared to GM or Ford, Ferrari caters to the high end, as we all know. And it's not like anyone can go into a Ferrari dealership and buy a new Ferrari. You need to basically own a Ferrari, and they basically have an application process because they don't want just about anyone owning a Ferrari. So even though right now people are talking about a recession and even a depression, because Ferrari caters to the high-end earners, they don't really see anything affected. And because Ferrari, they don't create a lot of cars at once, they basically have a backlog of orders, which means a lot of people are still going to be placing their order, which gives the Ferrari upfront revenue, which they can use to further expand their products. Next one, of course, is McDonald's. As you know, it's pretty much recession-proof because people got to eat, and if you're not able to get healthy food at home, you're most likely going to eat outside. And McDonald's being one of the more widespread, low-cost offering, a lot of people are still going to eat McDonald's, so that's why I'm invested. Estee Lauder is a makeup company, and like I said, even during recessions, people are still going to gravitate and buy makeup, even though people might not be going to jobs. People are still taking their Zoom calls, and to make themselves feel better, a lot of people might be buying makeup. So it's another good holding. And even though they cut their dividend recently, of course, when sales pick back up, they're going to reinstate that dividend. So it's also a dividend play as well. The next one is the TJ Maxx company, and they own TJ Maxx, Marshalls, Home Goods. Once again, they're able to offer their products at a discount, which is going to allow them to fare a bit better than other department stores like Nordstrom during the recession. And the final one I have within the sector is Wynn Resort. Of course, right now, no one is going to the casino because of the whole pandemic, but when they do open back up, a lot of high rollers are going to flock towards the highest offering, which is basically the properties at Wynn. So this is why I choose to invest in these companies, at least in the consumer sector. So let's move on to the next one. The next pie I have is the technology sector, and as you can see, I also have 10 stocks here as well. Most of them I'm sure you're mostly aware, so I'm not going to go into too deep of a detail. I invest 10% of this pie in Apple. We also have Facebook. Google, as you can see, I have a pie, but if you click on it, it's basically the two different Google stocks split evenly 50-50. Like I mentioned, even though I'm investing in a capitalist, I like it equally broken down, at least in my investments. So after Google, I have MasterCard. At the very bottom, you also see Visa as well. Basically number 1 and 2 in terms of the payment services company. So I decided to pick both of them as well. The next one is Microsoft, currently the most valuable company in the world. I think it's $1.4 trillion at there right now. And PayPal is another offering, at least in the payment option, because a lot of people are currently stuck online and they're going to be buying a lot of things online, sending money online, and they have Venmo in their portfolio. The next one is Salesforce. They help with customer relations management. And next one is Tesla, one of the most volatile stocks that is currently on the stock market. But as you can see right here, almost up 69%. So one of my top growth stocks. But I only own 10% of this pie in Tesla. So of course I might be making a lot more money if I had like 10% of my entire stock portfolio in Tesla. I choose to diversify my investment because once again, this is a retirement account. So I'm perfectly fine giving up on those gains if it means that I'm not going to be crushed if Tesla ever goes bankrupt. Next one is Uber. Even though their rideshare business is taking the beating because no one's able to go out right now, their Uber Eats business is basically exploding. So this is why I once again invest in companies that have different SKUs, like how Disney have their theme parks and their streaming service, Apple have their products, but also their services as well. Uber is a good play, at least thinking ahead in the future in terms of the autonomous taxi service along with Tesla. So holding number 1 and 2 of the winner within that battle is always a good investment in my book. And once again, Visa along with the MasterCard. So So that was technology. The next one is industrial. So even though this pie is titled industrial, I guess you can kind of rename it aerospace and defense, because I have Boeing, L3 Harris, Lockheed Martin, Northrop, and Raytheon. So I basically have 1, 2, 3, 4, 5. I guess you can count Honeywell as well. So 6 is basically in the aerospace defense. And as sad as it is, people are always going to have conflict. And the United States is always going to put a lot of their budget into the military, and a lot of them being major U.S. government contractors, that basically gives them a guaranteed revenue. So besides those 6, I have American Water Works. They're basically a water wastewater treatment play. Along with the very bottom, I have Waste Management and Republic Services, which also deals with waste management. Besides that, I have my newest addition here is basically Otis Worldwide. And if you don't know, Otis is basically, they deal with elevators and escalators. In addition to new installments, elevators, I'm not sure about you, but at least elevators at my work and also my apartment, they're constantly breaking down. So they also have that maintenance aspect, which means that they're going to get money regardless, because unless you want to walk up 10 flights of stairs, people are going to need their elevators fixed. So that was industrial. Let's move on to my next sector, which is real estate. So if you look at the different companies I have in my real estate pie, you'll see that I don't hold any shopping malls like Simon Properties or even residential living. The reason why is I feel at least malls, they're on the downtrend, so I didn't see any point of investing in that. But also residential, because with the whole unemployment, I feel that there are going to be people who won't be able to pay their rent and will be evicted. So that's why I don't really have any residential REITs here. But what I do have is I have American Tower. American Tower, in addition with Crown Castle, they basically operate cell towers. And with the 5G network being rolled out, they're going to be able to take advantage and benefit hugely from that as well. Also have the CBRE group. They do the realty, they deal with data centers. Equinix also deals with data centers. I also have extra storage space and also public storage. Sadly, with this recession and a lot of people being unemployed, people might not be able to pay their mortgage, but they're still going to need spaces to store their things that they have. That's why these two are more of a recession play. And even if it's not a recession, a lot of people have way more things than they need. So these two are my play with the largest storage REITs. Prologis, they deal with logistics centers basically, and Realty Income Core. I think this is the only monthly dividend company that I have. So the final one, I forgot to mention, is SBA Communications, which is like American Tower and also Crown Castle. They also deal with the cell towers and communications. And the final 10 stocks that I own is going to be in the VYM dividend. So these are basically 10 companies that I think are going to have strong dividends in the future as well. And even though the name of this sector is VYM, it's a mix between VYM and also VIG, which basically brings companies that are going to increase their dividends substantially. So the very first one is Bank of America, of course, one of the big 4 banks. And I also have JP Morgan right here at the bottom as well. The next one is the Dividend Aristocrat, Coca-Cola. They have their sugary drinks, of course, but they also venturing into milk and also non-soda related items, which is good. But I also have Pepsi here, and I do like Pepsi a bit more than Coke, at least in terms of their offering, because Pepsi have their own snacks division, and they recently purchased the energy drink company, I think Rockstar, so that also gives Pepsi more SKUs than Coca-Cola. The next company I have is Costco, and whenever I go to a Costco, it's always packed. And with this whole pandemic, a lot of people have been bulk buying, and so it benefited tremendously. And I also have Ecolab. They deal with keeping everything clean and hygienic, which is going to be more important during this pandemic and even afterwards as well. Johnson & Johnson's the world's largest healthcare company, so it's a no-brainer, at least because this is once again a dividend pie. Then I have NextEra. This is the only utilities company that I own. So I like to have a bit of mix of different kind of companies, as you can see, even within the dividend pie. The next one is Procter & Gamble. And the final one of the biggest beneficiary of the whole coronavirus pandemic, the Clorox company. All right, so there you have it. That's basically all 56 different holdings I have within my M1 Finance accounts. Once again, Roth IRA number 1 is my personal Roth IRA, and then I have Roth IRA number 2, which basically has the same 56 stocks. And the good thing is, I also get a dividend yield of 2%, which is going to be an additional income. And even though right now I only have earned $135 in dividends, as this account grows and as companies naturally increase their dividends, the dividend yield is going to go up, which is going to add to the more passive aspect of investing. So there you have it, my entire stock market portfolio. If you stuck through the whole video, you are the MVP. And let me know down below if you are invested in any of the stocks that I am invested in, or if you have any critiques of my investing strategy. I like to call mine, I guess, a passive aggressive strategy, because I am passive, that I am creating my own ETF basically to invest in. But I believe some of the stocks that I do own are more aggressive, so it's a bit more growth oriented in value if I had to pick between those two. So because this video was revealing my stock market portfolio, I didn't really give reasons to why I chose M1 Finance as opposed to the other brokerage that I've used. I've used Scottrade in the past and also Robinhood before moving to M1 Finance. So if you are interested, just let me know down below and I'll make a video basically talking about the benefits and also the disadvantages of M1 Finance that I found over the years. That's pretty much it. If you have any other questions or any other comments, definitely leave it right down below. Thank you so much for stopping by, and I'll catch you next time with more shenanigans.